Hello, guys. As you know, as a realtor, I get a lot of questions from my clients. Recently, one of the question I've been facing from the people, their mortgage payments are going up. And, with the COVID-19 coronavirus, people are losing job. A lot of the people they don't have income right now. Some of them barely living with the government assistance. It's so difficult when you get a shock in the mail. Your mortgage payments are going up 300, 400, $500. So there before try to understand well, how the mortgage payment is made of, there are four part or maybe five part of the mortgage payment. The first thing is your principal and the interest amount, and that thing never changes if you have a 30-year or a 15-year fixed mortgage. So that part is not going to change. Your variable is um, your tax and insurance, and you might have mortgage insurance which is different from your homeowner insurance. So your mortgage insurance is basically if you don't pay or if you don't own at least 20% of the equity of the house, you will have to pay mortgage premium until you reach to like your LTV, loan to value ratio, at least 80%. So so what you should do in this case, I think you should call your mortgage servicer and ask them why my mortgage insurance is gone, mortgage payment has gone up. What did change? Is it tax? Yes, tax might go up. It's happening with the good economy. There are some side effect, that is your house price goes up and CTSs the value higher and higher every year, and then your tax also go up, so that has a big effect on your payment. And on the other side, your insurance might go up. Insurance, although you don't have a claim, sometimes they go up for no reason, honestly. I mean, maybe they had to pay so much premium, so much insurance covers last year to other people, and they kind of average it on everybody. So anyway, you show it, you ask them like which part went up too much, that kind of triggered. And one of the thing, one of my client told me, they talked to the mortgage servicer and they told them by the April, um, it means the first 4 months, they want to have at least half of the escrow money in the account, which is really ridiculous because I mean in 4 months you are trying to have like 6 months of escrow money, so that definitely puts some pressure like, hey, your escrow is lower, so we need more money. And you know, I don't like escrow company having so much money collecting, and they are collecting interest on them. On the other hand, homeowners are struggling. So ask them like, hey, what is the home value, loan to value ratio? Am I owning right now 20% of the equity or not? Um, in most places, probably you are already, because the home price has gone up last few years, very much so. And ask them if you can do a appraisal waiver first. If not, you might have to do appraisal and it will cost you three, four, or $500, but it's worth it. You can manage your own escrow. For me, I do it myself. That means I only pay loan and interest to the payment to the mortgage servicer, and I do manage my own escrow for tax and insurance. So that means in the middle of the year, the insurance company say, "Hey, your insurance is about to renew, and are you ready to buy or renew?" And I pay them. And around like October, CT send me the tax bill. I pay them before the end of January next year. So yeah, it's better for me. What I do to manage these payments every month, I send my payment to a savings account where I save my total money. For example, if my loan and interest payment is $1,200, and I kind of do an estimate, okay, $600 I need for my escrow to cover my tax and insurance. So $1,200, $1,800, 12 plus $600, $1,800, I send it to my savings account, and I keep saving it. And savings account, I sometimes get some interest, so that's my money grows there. It's not sitting in other people's pocket and let them make money on my money. um, and I set up a direct withdrawal from the mortgage company, so they just take their payment every month on time, and my escrow money is sitting down there earning interest, and at the end of the year I use that money to pay my insurance and your the tax. And the other thing could be in your payment is if you owe less than 20%, you might have a mortgage insurance or PMI. Um, uh, MI for I think FHA, and PMI for the conventional loan. But in any, anyway, MI normally for FHA, PMI, I think it is a little bit expensive. It's around like $100 per month. So for conventional, it is a little cheaper, $30 40, actually a lot cheaper. So if you own already 20% of the equity, make sure you don't pay any more MI or PMI. Um, or if you are not owning 20% of the equity, unfortunately you'll have to pay that. But ask them like, hey, how much I'm paying for the PMI? Did it change or not? So if it doesn't change, that's good. If it changed, can you shop for it? Can you ask them to get a cheaper one? Why it went up? That might be the culprit. As a last resort, what you can do probably refinance it. I mean, right now the interest rates are very low, and uh, if you see even a 0.5% deviation from your current interest rate, yeah, it's probably at the end you're gonna save the money. So I would highly recommend that. So that's it for today. Thank you guys. If you have any question or comment, write it down below. I would love to answer that. Thank you.